All right. Well, thank you all so much for coming. It's so good to see everyone, so familiar faces and new faces. And I'm just so thrilled to have Katelyn and Molly here with us today. Katelyn and Molly are fund formation associates with Cooley. And I will actually kind of you will see their brilliance as we talk. So I am just going to, oh yes, and for people who don't know me, I'm Vanetta Young. I'm an investment readiness and fund formation advisor. Welcome to the Emerging Manager Roundtable, and I'm just thrilled that you all are here to be a part of the community, to learn and grow together, and looking forward to meeting with some of you in our breakout rooms after the interview. So we're going to start with a pretty basic question, but I think it's something that a lot of folks get hemmed up on, because it can be pretty confusing. So can you guys tell me, when is registration with the SEC actually required? Because I think that's not always super clear.
Yeah, absolutely. I'm actually going to take this question and flip it a little bit and ask the question of how do we avoid registration, right, in the first place? Which is usually the main goal of our VC clients, right? And going into it, there's two main exemptions that funds should be aware of, right? There is the private fund exemption, and then there's the venture capital fund advisor exemption. And you only need one of these exemptions in order to avoid registration with the SEC. Now, the private fund exemption essentially means that you're a venture capital fund that has under 150 million assets under management. And that assets under management amount is calculated across all the funds in which you advise, right? So as you can imagine, the idea is that you keep raising funds, you keep doing really well and being successful and grow. And so that private fund exemption has its own limited runway, right? Because eventually you're going to hit that capacity. You're going to hit that 150 million assets under management. And that's why most of our fund managers really want to try to make sure that they also have the exemption of venture capital fund advisor. And that venture capital fund advisor exemption essentially means that you are only advising venture capital funds. And by the test to making sure that it's a venture capital fund means that each one of your funds on an individual fund by fund basis doesn't have over 20% non-qualifying investments. And the best way that I tell my clients to think about what a non-qualifying investment is essentially just imagine anything that's not a direct investment into an operating company, right? So the key ways that this gets tripped up is crypto investments, fund-to-fund investments, or any sort of secondary market investment.
Got it. I feel like this might be the one roundtable where I'm like taking in information and I might have as many follow-up questions, because I'm like, this is, I'll be honest, a new world for me. As a former limited partner, I'm like, this is deeply complicated. But this is why I was not a deal junkie. But I find it very, very fascinating. And so I think one of the other questions that I get kind of a lot is, emerging managers want LPs to come in early. They want them to come in. They want them to come in as early as possible to be their anchors if possible. How can they incentivize LPs to do that? And I think another way of asking this is there a way for an emerging manager to like punish an LP for coming in late?
Yeah, so there's a few ways to do both of those. I guess we'll start with the punishment and then move on to the reward if you're an early comer. On the punishment end, the most common way to incentivize coming in early is through an interest charge. So if you come into our initial closing, then you're coming in at your commitment level and there's no sort of penalty on top of that. And then if you come into a later closing, you come in for your commitment level, and then there's a pretty nominal interest charge levied upon you as well. And not all funds do this, but I would say it's an increasing trend that people are doing this. And what's important to note is that the interest charge is actually being paid from the latecomer LPs to the initial LPs. It's not money that's going to the fund manager. And I mean, there's a couple arguments for why people do this. Essentially, you're taking a bigger risk if you're coming into the initial closing. So you get a bit of a better deal by doing so.
Right.
And on the later side, you've sort of seen how things are fleshing out. You're taking a little bit less of a risk. and you're sort of indebted to the early coming LPs because they took that risk and got things off the ground. So the interest charge is usually a really amount if they don't make it into the initial closing. So that is one penalty for coming in late. In terms of incentives for coming in early, you see everything from management fee breaks to co-investment rights or even successor fund rights. So saying, you know, our initial closers are going to get a lower management fee than everyone else pays, or if we do co-investments through this vehicle, those who come in early are going to get a first dibs on those deals. Or, you know, we're raising fund one right now. When we raise fund two, we're going to go and be able to give commitments to early coming LPs in fund one before we move on to those who came in later. One way that people also incentivize people to come in early is if you're in the fortunate position of being over allocated, oversubscribed, you can definitely, you know, reiterate to people, if you want your full allocation amount, I can only guarantee that if you're coming into the initial closing. You know, as we go through, things are gaining steam, we may not have as much room for you anymore.
That makes sense. I guess one quick clarification on the interest charge, is that on the amount that has been raised up until that closing, or is it on like the entire commitment?
It'll be on that investor's commitment amount. So if you're coming in for $1 million, you may have to pay 2% interest charge on top of that.
And oftentimes too, it's also just a factor of paid in capital at that time, right? So it's dollars at work. So usually it's something around prime plus 2% on paid in capital. To Molly's point, it's kind of our go-to stick that we use. As opposed to punishment, I like to say sticking carrots. So it's the go-to stick we like to use, you know, of a little bit kind of valuing the time, money, valuation, the risk assessment, everything that Molly talked about is spot on. Because obviously things like co-investment rights, you know, reduced management fees, reduced economics, you know, things like that, we really like to try to avoid and hold on to and protect for our first-time fund managers, you know, for a myriad of reasons. And so it's usually not something out of the gate that we want to make sure that that we're using unless we come to a point where we feel like we need to, right? And I think overall too, just keep in mind, I think a great way to help incentivize and keep investors on course is just by really driving the process with really clear timelines. I think quite often people kind of lose control of the process and they lose control of their communication and their distribution. And I think from day one, making sure that you're very clear and consistent in your initial distribution and initial engagement with that investor, of letting them know if you have an inquiry date or a comment date, you know, this is the date that we are expecting comments. If you're going to make comments, this is the date that we are going to have a close. And I think quite often it's, you know, sometimes people just slip and miss it, not because they're not interested or not because they don't want to, but they just don't even really know what's happening or what's going on. Right. And they may have multiple other you know, closings or funds or things that they're investing in. So I think to be very clear and be very kind of driven on kind of the execution and what the timeline is also just a really great way to help herd the cats.
Agreed. I mean, in the fundraising process, it's everyone has a lot going on. LPs are generally great. You know, they've got multiple diligence processes going on. GPs are obviously they're trying to do deals and raise capital. So keeping that open line of communication is definitely a best practice. And I think another takeaway from what you both have said is one thing that's striking me is that first-time fund managers actually do have like rights. So it's not, you know, you don't always have to sell your firstborn child to raise a fund. You actually can say, no, really, this is, there is incentive to investing with me. And I think that's actually pretty empowering in a way too. We did get one question, Riley Nielsen, I think I'm pronouncing that correctly. What about a pledge? Riley, do you want to add any color to your question, just to give us a little bit more context? I don't know if Riley is still there.
I can try to guess at it.
Yeah.
There's,
Oh, okay. Making it a break of contract not to invest by a certain date.
So typically we don't really make a contractual obligation to make a commitment to a fund that's not actually a closing on the fund, right? Because once you have a contractual obligation for someone to commit capital to the fund, you've had a closing and you're locking them into the fund, right? Sometimes what we do see is we have indications of interest, right? But usually those are non-binding. And for the reason that usually you get those indications of interest prior to the fund documents being formalized or finalized, or any sort of side letter negotiations or things like that. And so the farther away you get from a final formalized actual definitive agreement, the harder it is to stand up in court that this is actually a binding agreement, that all parties kind of came to the table and understood and had a meeting of minds. And so usually what we do is we use indications of interest where we're really just trying to get an idea of what's soft circled and what's there and what investors are kind of interested in. So we can get an idea as to, okay, how much harder do we need to drive for third parties, or how much are we just kind of from our pool of existing investors or prior investors, our various contacts, do we kind of have a critical mass that we need here? And also, just from a relationship standpoint, it's usually just not great business to get into the, kind of in the habit of taking gentlemen's handshakes and then trying to bring people to court when they walk away from that for different reasons. So it's a little bit of a balancing of that. Really, I would say indications of interest certainly have a use and are great. Rarely do we see them where they're actually binding and a contractual obligation to commit. Usually where you see the contractual obligation to commit is when they've actually submitted subscription documents and you've now accepted them into the fund.
Got it. That makes sense. That makes sense. Now, I want to kind of drill down on closings, particularly on an initial close. What does kind of a typical initial close look like, and what can folks think about in terms of a critical mass amount? Or is that something that's preset? Is it determined later? How should GPs go about thinking about this?
Sure. So going off of what Katelyn just said, also the most important thing is that you do not accept anyone into the fund until you have a closing. If you have returned countersigned documents and accepted capital from people in advance of closing, that is a problem. We're not doing any of that until after the closing has occurred. In terms of the mechanics of what a closing looks like, it's actually quite simple. It sounds like a pretty daunting term, but really you just have your executed subscription agreements in hand, your executed LPA signature pages from investors. You as the GP have countersigned them, and everything with the documents is sort of good to go. Now, typically the day before, 2 days before closing, you want to file your Form D. This is a public filing, so very important to note that everything on here will be available on the internet and available to be seen by others. So the Form D we typically file in advance, because if you file in advance, there's a question on there about how much capital you've closed on at this point. And if you have yet to hold a closing, you can obviously list that amount as 0. Since again, it's public, so everyone will be seeing it. So that's sort of a standard practice that we have. It's not, there's nothing wrong with filing it after you close. It's just that then you'd be disclosing that amount, which a lot of folks don't want to do, particularly if you've, had a first closing that's not the amount you're hoping to raise. And going off of that as well, what's a critical mass in terms of when to hold a first closing? Typically we say whatever, as much as possible, but whatever amount you feel you could still execute on your investment thesis with. So if you're seeking to raise, $20 million and you think you could still carry out the fund the way that you intended with $10 million, then holding a closing on $10 million makes sense. There's no set rule or anything on the amount that you have to close on, but if you have a $20 million fund and you get one $50,000 check in the door, you probably don't want to close on that. From a marketing perspective, also, a lot of funds like to be able to say that they held a fewer number of closings, so that kind of shows indication of interest. We closed on this much with only having 1 or 2 closings.
Which actually leads me to something that's really, I think is really popular in the venture space now, is this idea of rolling closings, which was very much a new idea to me. And I'll be honest, kind of sounded like a headache. So can you kind of delineate, what's the difference between a rolling close and a set close? And is there, I don't know, benefits? How should folks go about looking at doing one versus the other?
Sure. So, I mean, there's not really a hard and fast delineation between the two of them. You can say the closing is going to be on March 20th until you're blue in the face, but it may slip until the 21st or the 22nd in reality. And you may say you're only going to hold 2 closings, but it winds up being 4, so the way you kind of start the fundraising process may not be the way that you end the fundraising process.
Yeah.
But in general, the sort of drawbacks to doing a rolling closing is that, as you said, it can be pretty administratively burdensome, particularly if you have that interest charge that we talked about earlier, because then every closing you're faced with calculating how much latecomers owe. And in addition, the legal costs can add up of holding multiple closings. Every time you get a book in the door, you want to hold a closing. It just gets cumbersome at a certain point. But the biggest thing is really whether you're going to rely on 3C1 or 3C7. So without going too far into the weeds on this, 3C1 effectively allows you to let in investors who are just credited investors and not qualified purchasers. Qualified purchasers is a higher threshold. But if you do rely on 3C1, you're limited to 100 investors, 100 beneficial owners of investors. And if you do 3C7, you don't have that 100-person limit, but you have to have all of your investors be qualified purchasers. So one thing that people do, if you're a first-time fund manager and you don't know the specifics of what your investor base will look like, you don't know if everyone will be a qualified purchaser or if some will be non-qualified purchasers. In that situation, you kind of want to keep your options open in terms of whether the fund will be a 3C1 or a 3C7. And so typically you would sort of hold all of the non-qualified purchasers until a later closing, so you don't blow your exemption. So you have a closing on only qualified purchasers, you're maintaining your 3C7 exemption, and maybe you have a couple of non-qualified purchasers who've submitted documents. You sort of hold them to the side. If upon your final closing, you're under 100 investors anyway, letting in those non-qualified purchasers is not really an issue.
Right.
But if we get to the final closing and you're going to go above 100 people, you may want to set up a parallel fund. That's what's often done. And you put the non-qualified purchasers in this parallel fund, and they have to be under 100. But your original 3C7 fund is still intact and still fine. So that's a little convoluted, but basically if you're holding rolling closings and you're letting in everyone every single time someone submits documents, you can get above 100 really quickly without even noticing it. And it's a lot more difficult to track who is a qualified purchaser, who is not, have you blown your exemption.
I think it's just overall, I think just kind of at a high level, and not to make everyone's eyes glaze over, but I think when, as attorneys kind of in fund formation space, there's 3 key, exemptions, or 3 key regulations, I should say, that we're always cognizant of, right? It's the Investment Advisors Act, which we talked about at the top of this meeting, essentially talking about, how do we avoid registration, right? The second question is the Securities Act, right? And this is where it really is important with that initial closing, as Molly touched on, that we want to perfect, essentially a Reg D offering, which means that we are exempt from the general solicitation rules. We're allowed to go out. Our securities offering was valid. And I think that's why it's so important as you drive to that initial closing, keep in the back of your mind, okay, I can't accept any capital from any of my investors or countersign any documents until we file that Form D, right? Now I have my Securities Act, we're good to go. And it's usually a one and done unless you're, extending past a year, but think of it as generally a one and done, just file that Form D for that initial closing, right? And then the last one is the Investment Companies Act, which is that 3C1, 3C7, kind of all these letters and numbers we're throwing at you. And this is the reason why, again, it's, depending on how you have that critical mass initial closing, but also subsequent closings, this is all the information we're gathering as we collect subscription materials from your investors. And so it's not exactly like an emerging companies deal where you're used to, okay, everyone submitted their signatures, fine, we're good to go, all signatures are in, right? There's a lot more back of the, kind of back of the scenes work going on where we actually have to do an analysis as to the underlying status of that investor to make sure they check all the boxes and you're allowed to admit them. And so again, this is why that initial closing is very important, that you make sure that we've kind of been able to do that full analysis on all your investors and you have the green light, we filed the Form D, but also with the subsequent closing, that's why it's not just we have a signature in, great, let's go, right? There's ongoing considerations to talk through, such as, are you sure you want to let them in because this now blows your 3C7 exemption, which is the one where it's all qualified purchasers, which means you can allow like thousands of investors into your fund,
Right.
and now you can only allow 100 in, right? Which totally changes the game in terms of how much capital you need from each of those investors. Where are you in your trajectory and your target of hitting that target amount versus where you are now? And are you going to be able to fill it up with those kind of, considering you only now have 100 slots as opposed to thousands, right? So it's conversations like that of, okay, is this money worth it? Or is it in the long run going to actually hurt you to take this check? Because then you're not going to be able to get to your target, right? Because you don't have large enough checks going forward. So it's these kind of ongoing conversations that we want to have. But look, we do rolling closings all the time. And, usually I think critical mass ones are my preference from the and I think ironically, sometimes one of the best tools that we have is almost using investors against each other, in the sense that if we can pool and have a critical mass at an initial closing or even at subsequent closings, if you try to take on an institution one by one, right, it's going to be a much harder fight to take on that institution one-on-one, versus if you have multiple institutions, you can use them against each other, because you can say, look, we have all these other investors, nobody else has made this comment, nobody else is worried about it. How about you just realize that this is a little bit ridiculous and we move on, right? And you'd be shocked, but that actually works. And it's very helpful to be able to take them all on at once. And that also allows us to know where the real issues are. When you have an institution that's, 5 of the institutions have all made the same comment, it's like, okay, we should probably, this is a thing, we probably need to change it, versus again, those one-offs. And it's not just lawyers being annoying, and like, dotting the I's and crossing T's. This is also strategy, and it's really making sure that we're going in this strategically, we're arming you for this battle appropriately, and that we're guiding you in a way that you're going to be able to get to your target, knowing what your investor base is generally looking like, right? And so this kind of ongoing conversations that need to be happening in the background, and they're easier to have when you do it in clumps versus this kind of haphazard one-off here, one-off there.
Definitely. And I think one of the things that you touched on in terms of thinking strategically about your fund formation, one thing that you haven't said, but I will say out loud is, I sometimes find GPs think their attorneys are just for documents. You're here to get my sub-docs done, you're here to get my acquisition finance done, but your attorneys are there to be your advisors and strategic thinkers as well. Like there's a reason why people get paid a lot to do the work that you do, largely because I've sort of understood roughly every other word you've said during this roundtable. But no, I mean, it speaks to, not just the complexity of what people are doing, but how do you take advantage of that complexity and use it to advance your own fundraise and make sure that things are going to go better than even you thought they were going to. I want to open this up to questions. So if you have not yet put one in the chat or unmuted to ask one, please get ready. But we do have one first. Tessa asked, can you go up to 250 investors if your fund is $10 million or less if you're 3C1?
Yes, that's right. There is an exemption for kind of these 10 million or less funds, whereby you can actually include additional investors up to 250 to essentially help these kind of smaller investors kind of launch and get larger. Candidly, we just don't touch on them too often because usually our client base is just, it doesn't apply to them, but that's correct, Tessa.
Awesome.
Thank you.
Yeah.
What other questions do you have? Feel free to unmute or to put in the chat. Don't be shy. This is a very open community, I promise. There are no dumb questions. And if no one else has a question, I will continue talking. Oh, Eugene, go ahead.
Yeah, hey, hi. I'll ask a question. So we've seen a ridiculous number of funds launch and capital thrown into the fund world in the last couple of years. Do you see that slowing down at all in 2022, or do you think it's just going to keep increasing?
Well, Eugene, if I knew that, I wouldn't be an attorney. I would. No, all seriousness, it's funny. I would say even over the past 4 years, we keep looking around the table going, this can't keep going. This is incredible. This is our pinnacle year. And then of course we go and match it and we top it, right? And it excels. And getting out of those markets, and a lot of the companies that oftentimes you would get into in the public space are now, they don't have to go public, right? Which is pushing down a lot of capital and a lot of potential and opportunity into the venture space that I think people are just now harnessing and really kind of capitalizing on in the past 3 years. And I think it's kind of a really interesting phenomena that goes into, and manifests itself in really kind of interesting trends that we're seeing, of more and more people getting into the secondary space because that Stripe. So, a lot of these companies are just not IPOing because they don't have to anymore, right? And so it's kind of this new industry of even like an entire secondary market that's, ripe with opportunity. And cash is cheap, and, kind of now that interest rates are, or inflation is going up, it's almost kind of like, well, I don't want to just sit on my money because now it's depreciating, so let's deploy it. So,
Actually, I am curious about a few more of the sort of trends that I've been seeing, this move to RIAs and things. Can you just shine some light on that? I just want to know more about it because I've just heard more people doing it. Can you shine some light on what it means to get RIA status, and like what are the implications of that?
Yeah, so it's going to unpack the question a little bit. So first, kind of trends, which goes into the RIA status.
Yeah.
So, we've been seeing a heavy trend towards people coming out with more and more product offerings, right? So they essentially want to broaden their scope and their verticals. And so where it used to be, we only do early stage, VC funds, we're getting a lot more opportunity funds. We're getting a lot more growth stage funds. We're seeing a lot more secondary funds, to the point that it almost seems that a lot of these fund managers want to become the one-stop shop, right? They want to say, okay, if you want to diversify your portfolio, you can do it all here, right? You can have early stage, you can have a little bit of growth stage, you have secondary market. Having that RIA and people flipping into RIA goes to this kind of concept of the product offerings. Because if you remember, as I mentioned at the top of the call, once you're over 150 million assets under management, you really only have one exemption left. And that's the venture capital fund advisor exemption, right? But that means you really can't do a secondaries fund and you can't do a crypto fund. You can't do a fund to funds, right? Because again, you're subject to each of your funds can't do more than 20% of those asset classes, right? Or you blow the exemption and you blow it for your entire firm.
Right.
And so a lot of people are just finding that, you know, they have the back office administration for it, they have the capital and management fee income streams for it, and they say, you know what, we're just too hampered by the asset classes we can get into because of this ERA status, exempt reporting advisor status. So we're just going to register. And really, what does it mean? It means money and scrutiny, right? So it means usually once you flip into an RIA status, after that transition, you're probably going to get audited by the SEC, right? So one of the first things I always tell my clients is just make sure you have, you know, your ducks in a row. You know, you need to make sure that your books and records are, you know, all organized. You need to make sure you're all over your investment allocation policies. You're all over your marketing tools and what you've been saying in the industry. You're all over and very clean on your expense allocation policy. You've been consistent there. Just get ready because the proctologist that is the SEC is coming, right? And so that, you know, that's the big pain point, but that's usually kind of, as most things in life, it's usually the transition that's the hardest part, right? After that, it really is almost just kind of a money thing where I say it costs probably about $100,000 a year to be an RIA, right? And that's because you have additional compliance teams, you have, you know, just you need further back office administration, just the filings and the preparing of the long form ADV and that part too. You know, it's just, you need to have the money to be able to afford to do it, you know, that luxury of being able to afford to flip into that. And also just making sure your books and records are tight. But I would say, honestly, it's not as big of a deal as it used to be. There's so many compliance shops and compliance teams out there that'll help you through the transition. There's so many, you know, it's going on more and more, and it's a pretty streamlined process if you just bring in, you know, good, you know, back office compliance. That it's really not a huge deal. I think more often than not, I think the sticker shock is usually what gets a lot of our clients, and they have to wait until they are just larger firms and can afford and have the management fee income streams to be able to afford to flip into registration. I mean, not to say we don't have smaller shops that just bite the bullet and do it, but that's just kind of the considerations.
That makes sense. That makes perfect sense. We did get one more question. What do you think is the minimum mark of a pre-existing relationship with an LP in a 506B?
Oh, gosh. So I'm assuming this is an individual and not as kind of, you know, you're not talking about through a broker dealer or anything like that. You know, honestly, I don't think I would say there's a minimum. I always kind of go to my client and say, what's your gut check, right? Do you actually know this person? Have you had dialogue? Have you been talking to one another? How did you meet each other, right? And talk to me straight face and give me some facts and circumstances that if the SEC were to come around, you could straight face say, I know this person, we've had dealings before in the past. It wasn't, I went to a panel and I talked about my fund and then they reached out and now we have a pre-existing relationship, you know? But it's a gray area. I mean, it's a facts and circumstances sliding scale of gray. Honestly, we usually don't get into the weeds on this with our clients that much because you kind of know in your gut, like, is this a pre-existing relationship or not? And our clients know better than we do what that analysis is.
Makes sense to me. All right. If we have no other questions, I think we are ready to go into breakout, since I've gotten plenty of feedback, mostly from Chad, that this is not long enough and that we should be spending more time in breakout rooms. Thank you so much, Katelyn and Molly, for your time and for sharing us with all of this wisdom that is completely and totally foreign to me and was really helpful to get the insight. And thank you to the folks who asked questions. They were really good questions, very thought-provoking. We're going to break you up into breakout rooms so you can get to know each other a little bit better. We're going to hop back here right before we sign off. So don't leave from the breakouts, come back, and we will see you shortly.